Hi all, welcome to this session. So in this today's session, we are going to continue our last session, that is question practice for CMA USA examination part 2, financial statement analysis part. So let's move to our first question quickly. A company's financial data show that its account receivable turnover has decreased from 10 to 8 over last year, while its inventory turnover has increased from 5 to 7. Assuming all other factors remain constant, which of the following is most likely implication for the company's cash conversion cycle? The first option, the cash conversion cycle has definitely shortened. Cash conversion cycle has definitely lengthened. Effect on the cash conversion cycle is strictly dependent on the changes in accounts payable deferral period. The net effect of cash conversion cycle cannot be determined without knowing the total sales figure. So the question is asking it's assuming a changes in, or it's suggested or is confirmed a changes in account receivable turnover and inventory turnover ratio. It has improved. So definitely that is a positive impact. So which of the statement is correct? That is the question. So definitely the cash conversion cycle is their sales in inventory plus their sales in receivable minus their sales in payable. That is the formula for account cash conversion cycle. So here the answer is option 3. Definitely the impact of account payable conversion also has an impact on the cash conversion cycle. So we cannot tell the exact figure of exact changes in the cash conversion cycle without looking into changes in the account payable referral period or account payable conversion cycle. So here I am given the answer and explanation for this question. So because of the component increased and other one decreased, we cannot know the net impact, the total cycle, without knowing the account payable period changes or how many total days other two shifted. So let's move to question number 2. A company has a current ratio of 2. Which of the following transactions will increase the current ratio? So the current ratio, in the questions like that, what you have to do, you have to put a example for this question. So if the current ratio is 2, definitely the current asset, let's just assume 200,000 and current liability is 100,000. In this case, it is 2. Then let's assume case one by one. The first option, purchasing inventory on account. So it's purchased inventory on account payable. So the purchasing inventory on account. Just assuming the company is purchased for a $50,000, then the account, definitely the inventory will increase. So it is 250 divided by 150. So it will be less than 2. Again, it will not going to increase. Let's open my calculator. 250 divided by 150, it is 1.66. So option 1 is wrong. Using cash to pay long-term note payable. Is there any long-term note for the long-term payment or long-term liability payment? Company use the cash. Definitely it will reduce the current asset. So, and also it will decrease the current ratio. So this is wrong. Then the collecting an account receivable. Definitely collecting an account receivable will not change anything in the current asset or current liability because it's just shifting the account receivable to cash. That's all. It's both are in the current asset. So this will not have any impact in the current ratio. Then selling a fully depreciated piece of equipment for cash. That means in this case the cash will increase, and a depreciated piece of equipment which will not have any value. So definitely only the current asset will increase. Suppose the company sell for 100,000, so 200 divided by 100 plus here as a 100 increase are there, so 300 divided by 100, that is 3. So in this case, in this example, the option D is correct. Selling a fully depreciated piece of equipment for cash. So here I am given the answer and explanation for this. You can go through this. So let's move into question number 3. A company has a times interest earned 5. If the company's interest expense is 200,000 and tax is 30%, what is the company's net income? This is little tricky, a tricky question. So in this example, in this question, we have to calculate the net income. So what are the information are given? First one is times interest earned and the interest expenses. So we can calculate EBIT from this. EBIT, we can calculate from this. That is 5 into 200. That is 1 million is the EBIT in this case. So after EBIT, you can calculate the EBT, that is earning before tax. That is 1 million divided by interest expense already given, 200,000. That is 800,000. So this 800,000, you have to reduce the 30% tax expenses. Let me open my calculator. 800 into 30%. That means divided by 100. That means 240 minus 240,000. That is 560,000 is your net profit. So exactly the same option already there in the option. Same answer is there in the option, 560,000. So to answer this, you have to properly understand what is the times interest earned, what is the formula for times interest earned. So what is the formula for that? EBIT divided by interest expenses. This is the formula for times interest earned. You should know this formula to answer this question. Again, I am given the answer and explanation for this question. So let's move into question number 4. Two companies, company X and Y, operate in the same industry and have the same earning per share. However, company X have a PE ratio of 20, while company Y have a PE ratio of 12. So what is the formula for PE ratio? First, you have to know what is the formula for PE ratio. So let's move to question first. Which of the following is the most likely reason for this difference in PE ratio? Again, it's also mentioned that it is same earning per share. Investors perceive companies Y to have higher future growth potential than company X. Company X is perceived by market as having higher risk than company Y. Option C. Investors expect company X to have higher future earning than company Y. Company Y has higher dividend payout ratio, which is automatically lowers the PE ratio. So let's come to PE ratio. The formula for PE ratio, market price divided by earning per share. So here it's already mentioned that the PE ratio already given, and also the earning per share also already given. So just come to company Y. Company Y, the PE ratio is already given. It is 12. So in this question, what you have to understand, the concept of PE ratio, that's you have to understand, that is market price per share divided by earning per share. So here it's clearly mentioned that earning per share are same for both companies. Again, the PE ratio already given. So the PE ratio now here it is impacted only the market price per share. So we can understand that the company X have more market price than company Y. Company have a lesser market price per share. So both company have same earning per share, but the company X market price is higher than company Y. Again, we come to the question one more time. Which of the following is most likely reason for this difference in PE ratios? So now we understand company X price is higher than X, Y. Here more price, here less price for company Y. The investors perceive company Y have more future growth potential than company X, because it is wrong, because It is just the opposite. Company X have more market value. Company X is perceived by market as having higher risk than company Y. No, because its price is higher, so it's there. It is not related with the risk. Investors expect company X to have higher future earning than company Y. This is the exact answer. Option C is the exact answer, because the investors are expecting this company X can have more future earning than company Y. That's why the investors are willing to pay more money for its stock. So here the option C is correct. Definitely, if a company, the investors are expecting more future earning or higher future earning for a company's share, definitely the investors will willing to pay more money for that stock. So here I already given the answer and explanation for this question. You can go through this. So let's move to question number 5. A company has a times interest earned ratio of 4. If the company interest expense increased by 20% and its EBIT, earning before interest and tax, remain the same, what will be the new times interest earned ratio? So how we will calculate? Currently its times interest earned is 4 and its interest expense increased by 20%. And the EBIT or earning before interest and tax remains same. So what will be the new times interest earned ratio? So in this case, what you have to do, apply these numbers into a example. So if the times interest earned is 4, definitely we can create an example here. Just assume your EBIT divided by interest expenses. That is your EBIT divided by interest expense is your times interest earned ratio. So here just assume my EBIT 1 million divided by 250,000. This is exactly 4. You can put any number here, but the ratio should be 4. You can put 100,000 divided by 25,000, which will match logically, which will match. So in this case, what now the question is, if the interest expense increased by 20% and EBIT remains same. So just apply 20% to interest expense. Now it is 250,000 into 1.2. So it is 300,000 and the EBIT remains same. So what will be the new times interest earned ratio? So 100,000 divided by, here we see that it is 300,000. So the answer is 3.33. So if you get question like this in the example, what you have to do, you have to apply this into a real example, so the calculation and your thinking will be more faster. So here the option B is correct, 3.33. All you have to know only this, for this calculation only you have to know the exact formula for this times interest earned. That's all. Then you have to apply your logic into the question, so you can easily find out the answer. Definitely you should try to apply a example for this. So definitely this will help you to solve this problem quicker and faster in the examination. So again, I already given the answer and explanation for this question. You can go through this. Then let's move to question number 6. If a company's total asset turnover is 1.5 and total assets are 1 million and the company has net profit margin 10%, and what is the company's net income? So here the asset turnover ratio already given and asset value also given. So what is the formula for asset turnover ratio? Asset turnover ratio formula, sales divided by average asset. Average total asset already given, it is 1 million. So 1.5 divided by 1 million. So it should be 1.5 million. Then only it will match this 1.5. So just say like this, you put a number here, put the real example here. So it is very easy to solve the question. So in this case, the sales is 1.5 million. And what is the company's net income? And also the net profit margin also given in this case. So it is 10% of 1.5 million, that is 150,000. It is exactly option number B. Again, I already given the answer and explanation for this question, so you can go through this for better understanding. So let's move to question number 7. Which of the following would cause a company's inventory turnover ratio to decrease while all other factors remain constant? So here, which of the following situation the company's inventory turnover ratio will decrease? This is the problem. So before reading the options, what you can do, you can just write the formula for inventory turnover ratio, that is sales divided by average inventory. Again, it is average to decrease. So to decrease this, we have two options. One thing, sales has to decrease or average inventory has to increase. These are the two options to decrease this ratio. This is inventory turnover ratio. To decrease the inventory turnover ratio, first thing your sales has to decrease or your average inventory has to increase. So let's read option one by one. A switch from LIFO to FIFO to LIFO inventory valuation during a period of price rising. If you change the inventory valuation method from FIFO to LIFO during a price rise period, what will happen? Your inventory value will decrease because you are selling the latest products during the rising price period or during the inflation period. So definitely your cost of goods sold will increase and your average inventory value will decrease. So definitely this option is wrong. Second option, a decrease in the average amount of inventory held throughout the year. If the average inventory held is reduced, so definitely this is also wrong because we have only two options to reduce the ratio. First thing, the sales has to decrease or the inventory has to increase. So let's move to option 3. An increase in cost of goods sold due to higher sales volume. Again, if the sales increase, it definitely will increase, not decrease. So this is also wrong. So option number D, a slowdown in production process leading to higher level of work in progress and finished goods inventory. So definitely this will increase our average inventory and decrease the inventory turnover ratio. So option D is correct in this case. So I already given the answer and explanation for this. You can go through this. So let's move to next question. If a company has current ratio of 1.5, which of the following transaction will decrease the current ratio? So in the same time, we'll apply into an example, so that if the current ratio is 1.5, mean it is 150,000 divided by 100,000. Is current asset divided by current liability. Now it is 1.5. Then which of the following transaction will decrease the current ratio? Purchasing 20,000 of inventory on credit. If it is purchased, what will happen? The current asset will increase to 170 and current liability will increase to 120. So as a result, what will happen? $170 divided by 120, 1.4. So 1.4, that means it is decreasing this. So the option A is correct. So here is the option 1 is correct. Option 1 is, if you purchase a 20,000 inventory on credit, definitely it will decrease your current ratio. I already given the answer and explanation for this tier. You can go through this and understand the concept. So let's move to question number 9. A company has total assets of 500,000 and debt equity ratio is 1.5. What is the company's total shareholders equity? So its total asset is 500,000 and total debt equity ratio is 1.5. So there is an accounting formula. Total asset is equal to total liability plus equity. In this case, the total asset value already given, that is 500,000, and liability and equity both together is 1.5. Liability debt to equity ratio is 1.5. So debt is 300 plus equity is 200. You can get this from this formula. So if the debt equity ratio is 1.5, mean it should be 300 divided by 200. Then only debt and equity will be 1.5. So what is the total shareholders equity? That is 200. You already calculated. So option A is correct in this case. So you can go through this exam, this explanation and answer for more details. So let's move to question number 10. Which of the following is considered a solvency ratio rather than a liquidity ratio? Cash ratio, day sales outstanding, times interest earned, quick ratio. So as we know, the liquidity ratio, cash ratio is a liquidity ratio. Day sales outstanding is related to liquidity. Quick ratio also related to liquidity. Times interest earned, it is a solvency ratio than a liquidity ratio. I already given the answer and explanation for this question here. So you can go and refer this answer. So this is about today's discussion. If you have any doubt or you need any clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.